Okay, so we're going to start off in Chapter 17. It's a discussion about other taxes. These are laws that, again, are in effect for 17, because that's the year we've been studying, and 2016 and 17. So, some of these will apply. If you've been following in the news, all of the changes to the tax code, some of these may disappear. We'll talk about alternative minimum tax. We'll talk about the Kiddie Tax, unreported Social Security and Medicare tax. We've already talked about when it goes back to when we were talking about tips. We'll talk a little bit about household employment tax. We'll talk about the terribly odd one called the FirstTime Homebuyer credit. And then we'll talk about the rest of the taxes that are there on our list for the chapters. Again, not much that we talk about in this chapter or we see. That's why this is kind of lumped together in a chapter at the end. Just kind of these little taxes that you might see. Some of these I don't see during the year when I prepare taxes. Some of them you do. Some of them just understand what's going on with the taxes. Okay? All right. We're going to start off with the alternative minimum tax. Okay? As it says there, it's on line 45 of the Form 1040. Basically what this is that upper income, when their tax bill is reduced by what they may have on their itemized deductions or their exemptions or other credits or whatever it may be, the government and the IRS has decided, hey, that's not fair. You still need to pay at least this amount of tax. So just as it says, alternative minimum tax. All right. It's over the regular tax. It would be calculated in their tax bracket based on the tax tables. So it just, it's as it says here, the law sets the AMT exemption amounts and AMT tax rates. Taxpayers can use the special capital gain rates in effect for the regular tax if they are lower than the AMT tax rates that would otherwise apply. Again, confusing sentence, but basically what this is saying is those upper income folks, they are subject to this tax to make sure that they are paying a certain amount of tax because of their income. Okay? It is on the Form 6251 to determine how much they owe on the alternative minimum tax. If you've seen it, it's a picture of it here on page 17.6 and 17.7. It's basically its own tax return again. We've talked about that with a lot of our different forms that we have within TaxWise and the tax returns. So it's almost like its own little tax. As far as the levels of income, really anything over the $118,000, as far as the income that comes in there. If you look right here, you can see within the form, it talks about here as far as, what your income may be for the different thresholds. And then, in the calculation of this tax, here's your, if it's not over that, then you enter this and different things. So the calculation, so you can see those thresholds where somebody would be subject to the alternative minimum tax. Single, $119,700, married filing joint, $159,700. Okay. And again, up here above, there's certain things that they're limiting or they're putting back in there or they may add back in. Again, the TaxWise does a very nice job of calculating it for you. But as it says here that, these are the people, common adjustments and limitations. Some people that get to that income, they've probably had to phase out of the child tax credit. They've probably phased out of a lot of other credits, probably phased out of personal exemptions, different things like that. And again, it's there in place to make sure that the taxes are paid. Okay. Not going to expect you to know all the calculations that take place on the second page here, for the alternative minimum tax. Again, TaxWise does a very nice job of it. You just have to be aware of it with those numbers that we just talked about with levels of income to make sure that, your client would understand that they see this additional tax placed on their return. Why is it there? Well, again, because the level of income that they have and what adjustments they may have had on different things to net down their income, the IRS and the federal government has determined that, hey, that's too low. You need to still pay a certain level. So they'll add this alternative minimum tax on there. Now, 17, by the looks of it, with everything that is in the tax law, is going to be the last year that you will actually see this. That's one of the things that is in the chopping blocks that they want to do away with, is the alternative minimum tax. So you're probably going to see this go away. Okay. The next tax we have is the Kiddie Tax. Okay. This is one basically that is for unearned income for children. Okay. There's two rules of follow that must affect the tax on the unearned income of certain children. If the children's interest and dividend income, including capital gains, total less than $10,500, the children's parents may be able to choose to include that income on the parent's return. Okay. If the child's interest, dividends, and other unearned income total more than $2,100, part of that income may be taxed at the parent's tax rate instead of the child's tax rate. Okay. Basically what this is if you have a dependent on your tax return and they receive investment income, say that somebody bought them a lot of bonds when they were born and they go to cash those to go to college, and that interest income on those is over $2,100, then you're going to be subject to the Kiddie Tax. Okay. Or if they have something that is in their name, as far as an investments or something that maybe grandma, grandpa, somebody long lost relative put in their name so that they could have a income conduit, if you will, to fund their college or get started in life, or start a business or whatever it may be. But that income is taxed at a higher rate. Okay, so basically what this is any investment or unearned income. Again, we're talking unearned income. Not if the kid's working, summers at summer camp as a counselor, or has a part-time job at Tim Hortons, or whatever may be the situation. This is where we have the kids have investment income, unearned income that is more than $2,100. Then they have to do what's called the Kiddie Tax. Okay, don't see this very often. The reason being is to avoid the Kiddie Tax. A lot of these things are set up in trust. Okay, and if that's the case, then it's handled totally different, because it's handled through the trust return. All right, the estate or trust return that you would do, at 1041. That's where that income would be handled. So a lot of times you don't see this unless it's kind of an unexpected situation where there's not a trust set up, and like I said, it may be bonds where they have this interest income. So what happens is the parents can elect to have that income put onto their return, and they would pay the tax on it at their rate. Okay. There's a worksheet, as it talks about here, the 8814 form. The other form that you use is the 8615. Okay. So depending on what that is, and you can see the different tables there, that's where you will determine which is the most advantageous within the law as far as where that income shows up, whether it be on the parent's return, taxed at their rate. It may be the case because of the amount of investment income that it has to stay on the child's return and it's taxed at the parent's rate. But again, you do the worksheets, you do the two forms, the 8814 that's shown here, where the parents elect to report the child's interest, so that's on their return, and then it shows up on the parent's income. Or you do the 8615 to show the tax on unearned income to figure out the child's tax part. I get maybe one of these, two of these a year. Like I said, most clients that have this circumstance have things set up in a trust where it's handled totally different. Okay. Excuse me. Unreported Social Security and Medicare tax. Again, as you can see right there in the middle of the page, we have a reference back to Chapter 3 on earned income. Typically when we see this is on tip income not reported to the employer. So they're going to pay that Social Security Medicare tax on the return. Okay, so that's where we would see that. That's the most common case of this, that we would do it that way. But again, make sure that you understand that you have that Social Security Medicare tax that is on the return there, okay? Household employment tax. This is one that comes up more often than not, okay? It's an interesting situation because a lot of times people are kind of unaware that they have a household employee. It's as it says here, is someone hired to do household work, and the worker is an employee. The worker is an employee if the taxpayer can control not only what work is done, but how it is done, maybe the time that they are there. It doesn't matter whether it's full-time or part-time, but if the individual that is hiring this household employee dictates most all of their, their responsibilities or the time that they are there, then it's a household employee. Household work, you can see a list here, does talk about a lot of these. Where we see this most often probably handled incorrectly is somebody with a health aide or a private nurse. Maybe you have a parent that is at home and you have somebody that comes in. If that person is hired by you to take care of a parent or a relative, then they're an employee. They have to basically be there at a certain time because you dictate that. You dictate their responsibilities as to what they do, when they can leave, things like that. So just that pure description, that's an employee. Sometimes this is a situation where people will do this to avoid the cost maybe of somebody that's hired as a visiting nurse that's covered by insurance or whatever it may be, where you're not paying them. It's coming from a separate source. But if this is somebody that you have hired on an individual basis to do different things around the house, again, it's an employee. Okay, so you have to handle them such. All right. That being said, when you're an employer, you have to pay in the employment taxes for them. Okay, you would pay their their deductions depending on the withholding, but you would also pay unemployment tax, Social Security, Medicare taxes. You have to just as your employer would do for you, then you have to do the same. There's a little table here that talks about, do I need to pay employment taxes? Well, pretty much outlines what we talked about and the amount that we pay. Social Security, Medicare taxes, you would pay those in. The federal unemployment tax, that would go in. All this is done on a Schedule H, okay? So basically, when you're paying somebody on there, you have to pay in to that, fund or whatever, just like an employer would, okay? Yes, they would be a W-2 that you would give to them because things would have to correlate between the two sides of the equation. You have the side of the equation where the employee, the household employee, is receiving income from you, and then they would receive the W-2, so that is taxable on their side. And you have the side of the equation where you have to pay in all the employment taxes for them. Things that you would withhold from their pay, you can't keep, you have to turn into the government. So that's where the Schedule H would come into play. Okay? And again, nothing any different than any employer-employee relationship would do. These are things that employers, small businesses that have W-2 employees or whatever, they have to file this, and the Schedule H is done. And again, you're paying the taxes on there as far as the withholding, the federal tax, the unemployment tax. You can see all the different percentages, of what is withheld from their check that you pay to them. Okay. First-time homebuyer credit. The oddest credit that was ever created by the federal government. There was a window of about 15 months where everybody that got this credit had to pay it back. If you were on the other side of that, you did not pay it back. Okay, so the first-time homebuyer credit, as you can see, those for individuals and couples who purchased a home as their primary residence after April 8th, 2008, and before May 1st, 2010, the first-time homebuyer credit was a refundable credit, all right? So that's where they had this. Now, as you can see there, For homes purchased in 2008, the credit, with some exceptions, must be repaid and take the form of a $7,500 interest-free loan. Basically, the people that took advantage of this first-time home buyer credit on their tax return would be paying that back at $500 intervals, okay? Now, for homes purchased in 2009, prior to November 7th, the credit was for a maximum of $8,000, and they did not have to pay it back, okay? So you can see that there's these little windows that basically some people got it and had to pay it back. Some people got it and didn't have to pay it back, okay? You can have two people walk into your office, back-to-back appointments, that probably bought a house within 6 months of each other, and their first-time home buyer's credit would be handled totally different between the two, okay? The repayment of it is done on a 5404. This is one of the most common declines of an electronic filing that we see. The reason I say that is the IRS knows who's, by Social Security numbers, who's supposed to have their first-time homebuyer credit on that return. So if you get a new client and it's rejected for that, they may totally forget, because it's one of those things that's just always been taking $500 out of their refund to pay back this loan that they had, interest-free loan, okay? And then also there's at the bottom of the form, when you go to complete the 5405, there is a place where it talks about the selling of the home. So obviously, you know, if the home sold before the repayment of the credit, then you have to reconcile there on that part to be able to say, hey, you know, out of my proceeds or whatever I had, you know, do I owe an additional or do I have to pay off the rest? You know, there's a calculation based on whether it's a gain or loss on the sale of the house. Okay. The additional Medicare tax, really what this is it's a penalty that's issued to high income folks due to the Affordable Care Act. It's one of those things that was tacked on there to help cover the cost of the Affordable Care Act. And for those high incomes, you can see the 16 thresholds, you know, that income there is what people start to get this 0.9%. So, all right. Okay. All right. Okay. And there's the calculation of the form for the additional. Okay. Net investment income tax, again, something you just don't see. Okay. So, you know, it's there for your reference, there for information. Okay. Tax withholding and estimated tax. One thing I tell my students and my clients is tax withholding, you have to decide when do you want your refund, okay? What that means is when you go to fill out your withholding forms for your employer on a W-2, do you want more money in your paycheck and less in your refund, or vice versa, okay? If you want a bigger refund, then you claim less allowances. So if you do single zero on your withholding allowances, that is the greatest amount of withholding, okay? And that would generate a larger refund. Now again, based on that refund, most of that is your money unless there are several refundable credits that you're eligible for. And then that would add to your refund. But basically, you're giving your money to the government on a interest-free loan until you ask for it back when you file your tax return. If everybody's comfortable with that, or that they budget that way, then that's fine. Some people will say, no, I want the money throughout the year so I can spend it how I want. I don't think the federal government or the state government does a very good job, so I would like to be able to spend it the way I like. So, you know, they'll maybe do single one or two, so there's more money in their paycheck without the expectation of a higher refund. Okay, so we have that. Now, the other thing that's on here, yes, I'll sit down at the beginning of the year and talk with clients about how much they should withhold. We do a little what-if mode and a little what-if scenario on the return from the previous year. And then even while I'm doing the return, I may sit with them and say, hey, what's the upcoming year going to look like? You know, what's your pay? You know, what's maybe some financial obligations that you might have, whatever it may be, and we can kind of plan their withholding for that. Now, the one thing I want you to remember when you talk to somebody about withholding is it doesn't because when you first get hired and you fill out that W-4 or that IT-2014 in New York, just because you filled it out for the federal and state withholding doesn't mean that it's set in stone. You can change your withholding anytime you want throughout the year. There are clients that'll come to me about October, and we'll sit down and they'll say, how do we look? Based on the income they maybe have from their pay stubs, we'll say, looks like you've met your tax obligations as far as your withholding, so you're in good shape. Everything after this that's withheld probably going to be part of a refund. Excuse me, and they may choose to go with less withholding the remainder of the year. The reason I say that is a little more money in their pocket going into the holidays. Maybe they have kids for Christmas shopping, whatever it may be. But that way that they can take and have more money in their paycheck and not have to wait to get it back on their refund. Okay? Now, the other part of this is estimated tax. Okay? As it says, if you have $1,000 or more, as far as your tax due, then the IRS has determined that you have not paid your taxes in a timely manner. That's where you would sit with somebody and maybe talk to them about doing quarterly estimated. Obviously, the most common case of this would be somebody that is self-employed. Okay? If they are self-employed, they are not having federal and state tax withheld from their net profits on their Schedule C. So in that case, because they have to cover their self-employment tax, they may want to set up quarterly estimated to pay in. All right? Because if they owe $1,000 or more, there's going to be a penalty at the end of the year that's going to say, hey, you didn't pay it timely. So it's always a good instance. Now, sometimes with estimated taxes too, it may be a one-shot deal. I have some clients that come in that have old World War II bonds that were bought about them, and that's part of their retirement. They go to cash them in. They cash them in before the end of the year. We kind of do a one-shot estimated payment so that when we go to do their tax return, it doesn't show that they owe that tax then where there would be a large penalty. We try to head off that penalty by making a payment before the end of the year. Okay? So those are instances where estimated taxes come into play. All right. Talks about the different things. Again, we're talking about that W-4 that you fill out on the federal. States have their own withholding if there's state tax. And again, changing withholding, you can do it whenever you want. The one thing I would encourage, though, is if you change it, make sure that the client understands that they have to change it back and to verify. I cringe at the number of times that I have clients come in that, their company pays a large bonus at the end of the fiscal year, say in September. So in order to not have that large, bonus taxed at a higher rate and then have to wait to get it back on their tax return, they'll go exempt so that they can get the full bonus. Well, sometimes then they forget to change it back. And this day and age of electronic distribution of pay stubs, they forget to look. Hey, did it get changed back? Well, if it's not changed back and we don't realize it till we go to do taxes after the end of the year, then they're kind of out of luck. It's not like they can go to their employer and say, hey, you were supposed to be taking money out, and they change it. It is the responsibility of the employee to make sure that the withholding. So, I encourage everybody to make sure that they are looking at their pay stubs to make sure the withholding is being done as they would like. Okay. Little table here talks about sometimes personal financial changes where you could change some things for your W-4. Okay. And again, estimated, we kind of talked about that a little bit there as far as paying those estimated. There's a nice little screenshot here of a withholding calculator. The one that I use is at a website called yourmoneypage.com. It's kind of a quirky little looking thing, but it seems to work a lot better. Sometimes the IRS stuff gets a little bit heavy to look at. This one, again, it's yourmoneypage.com. And it's a great little, calculator that can do all the different states' withholdings. You can put some different things into it and such on that. Okay. We talked about estimated. I will kind of show you that when we get into one of the problems here. Okay. Because you're the federal and the state. Okay. All right. So we're going to move on to Chapter 18 real quick. We'll talk about amended returns again. I'm going to go into a problem and kind of show you that one. As far as everything in this chapter, again, everything in this chapter you're basically talking about is everything that you have to do in order to be able to be a tax preparer and what that is, okay? So it talks about all the different things, you know, as far as the terminology, you know, who can talk about the return, who you can talk to. If your name's on the bottom of the return as a, you know, a tax preparer, you know, basically you cannot even talk to the IRS unless there's a power of attorney in place, you know, unless that, and then, you know, if they do want you to talk to the IRS on your behalf, you know, it would have to be a three-way conference call that would be with the IRS or a state agency or whatever it may be to be able to talk to them, okay? So just make sure that you understand that all that, you know, as far as who can talk, who can't talk, the authorizations and things like that to be able to talk to somebody as far as the tax return, okay? As a tax preparer, you know, basically that's what you will be. You'll be somebody that'll be compensated for preparing tax returns for somebody else. You know, there's certain things that you have to make sure that you do, you know, as far as getting your credentials, your continuing education, being licensed through the IRS. You know, you'll get a PETN, it's called. It's basically a tax preparer's ID number. You'll also get a New York PETN. Reason those are in place, you know, it used to be the case that a tax preparer would put their social security number on the bottom of somebody else's return. Not a good idea anymore in this day and age. So that's where you have these and all the returns that you prepare. You have an ID number through the IRS, and it's, you know, two things: to protect your personal identity, but it's also to show that you are registered and you have met the criteria or the credentials or the continuing education to be able to be a tax preparer on a return, okay? The other thing that's in this chapter that it talks about quite a bit is all of the things that are your responsibility as far as meeting your ethics, okay? As the sentence says right there in the middle that we have, and it's kind of where you have to realize as to what your responsibility now is that with great power comes great responsibility, okay? What that means is, you know, the fact that you are basically controlling somebody else's money, you have to make sure that you are knowledgeable on the tax law, that you do everything within the law, and that you make sure that you have done your due diligence to make sure there is no fraud, and nothing can be construed that you and the taxpayer or whoever you prepared the return for were in cahoots, I guess, to be able to get a bigger refund because of fraud, okay? And again, we've talked about this one. The biggest one that we have that is the one that the IRS talks about most often, and that is the earned income credit, okay? It is a penalty that is very, very much a, you know, they go after you, okay? You know, not only you, but the person that also is the taxpayer on the return. As you can see there, the client can be kept from claiming a EIC for 2 to 10 years. You know, if it's done when the child's young, 5 or 6 years old, it could be before, you know, almost when they're graduating for high school before they get that earned income. It's a lot of time raising a child that you don't have that credit. So you don't want to put the taxpayer in that type of situation. Equally, you can see the penalties that are there, okay? Some of the minimum penalties are $5,000 or more, subject to criminal prosecution, won't be able to file tax returns. So there's a lot of things between the two sides, both the taxpayer and the tax preparer, that you need to make sure you do your due diligence on that. Ask for documentation, get that documentation, everything else that would be in there, okay? All right, there is on page, and again, like I said, you see all those little circular S's, those are always, or excuse me, interlocking S's. Those are always the case that, you know, that is verbatim from the law, okay? as you can see here, there's kind of a little summary of the penalties under U.S. Title 26 for anything that a tax preparer or taxpayer, may do. Okay, making sure that you have all the correct information that we have. That we need to make sure that we have our identifying numbers, that we're signing the returns, that we're getting the signatures from the tax preparer, and making sure that number's right. There's instances that I've heard of practices where for some reason the numbers weren't going in correctly as far as the tax preparer's signature on the bottom there. $50 a return. That can add up in a lot, up to $25,000 penalty. Okay, retaining copies of the returns, making sure you're filing your due diligence and all supporting forms, fraudulent statements, everything there is kind of recapped as far as what those penalties are. You just have to make sure that you are completing that return as accurate and complete as possible. Okay. And here's some penalties at the end for the taxpayer. This is some things that you should be knowledgeable of as far as the penalties that they may have for different things that they may do. Again, your due diligence, as long as you have all things that you have covered as far as the tax preparer, you need to make sure that they've done that. If it's something on their side that is negligence or they did not disclose, again, as long as you have them sign that full disclosure form that says they provided everything accurate and complete to the best of their knowledge, and they sign off on that, then pretty much, everything is in place for that. Okay. All right. Any questions to this point? Okay. Anything for 17 or 18 to this point? Okay. We're going to take 5 minutes. I'm going to get set up in a return. Come back. We're going to kind of talk about the amended return as far as in a return. It's much more beneficial to see it and understand what we're doing there. And then we'll talk about estimated payments there too and a few of the other things that are here. And then after that, after the break, we will talk a little bit about New York State. And then anybody else that has questions about the state that they are in, we can bring up a state return on that also. Okay. All right. So we're going to take about 5 minutes and we'll see everybody. And because they've already filed this return electronically, we're going to have to amend it. Okay. So again, page 231 in the workbook, we're taking a look at it there. We're going to amend their return. Everything else is in there as it stands. So we're going to take a look and say, okay, we need to amend this return. We need to send it in, and in this case, it's going to go in paper, but we need to amend it. So the first thing that we're going to do is we are going to change, okay, that the fact that we're going from being an electronic e-file to a paper return, okay? So we're going to change that. Then we're going to go up to our add a form, okay? And what I mean by add a form, if you look right up here, all these little tabs, sometimes I'll refer to those, but we're going to go this first one here on the left. We're going to use that one, and we're going to do add a form. And then anything that has to do with an amended return, whether it's on the federal or a state return, is always done with an X. So if we look, I've highlighted in blue here, amended individual 1040X, okay? So we're going to open that. Gives us a question. You have chosen to add an amendment form to this return, okay? If that's the case, we're going to say yes. All right. On our tree on the left, you can see our 1040X, and then you can see this amended return, all right? Now, before you do anything else, anything at all, what I want you to do is check this box, okay? You have to override everything. So basically what that's telling you is that you're going to override everything on this return, okay? Next thing you're going to do is you're going to go down to the New York. Again, add a form display, okay? You go into your New York list, and we do in a 201. So you go down, you find your New York amended. Same thing, it's added here. First question, override. Yes. Make sure you override that, okay? That way anything that you change is truly an amended. In this case, yes, we're doing amended return here, okay? Now, so we have our amended return form, and you can see it right here, similar to what we saw in the textbook. It has the original column here with the gray with the red numbers, if something changes, and then what our new return is going to look like. This is really just a summary page of anything that we do in the amended return. So we're going to override. Then basically what we're going to do is go back to our 1040, and it's as if we're just continuing right where we left off when we finished their return before. Okay? So in this case, they're going to come to us and say, you had additional student loan interest. So we're going to go down to our adjustments to income. We're going to find our student loan interest on 33. We're going to go in there, hit F9, find our little worksheet. And in this case, they had $783, okay, that we put in. All right. And then the other thing is that there was dependent care that they forgot to tell us about. Well, just as if we were doing the return originally, we'd have to go back to the main info, go down to where the kiddos are at, and if we remember, you know, I know this is back a few chapters, okay, but as we remember, right here, this column, the DC column on our main info after the kids' names, that's where we would see our dependent care. So we're going to check dependent care for the two kids, okay? All right, and then that generates our 2441 on the left. Again, we're just continuing just like we had the return before, and we're just adding these. So we got Humpty Dumpty, and that is obviously on Humpty Dumpty Lane. Okay. And we have an EIN number for Humpty Dumpty. Okay, and they spent $2,025 there, split between Deborah at $1,025 and Donald at $1,000. Okay, so those are the things we had to add. All right, now we're going to go back to our 1040X. We can see here that, you know, because of the 783, that was the amount of student loan interest. We had a change in everything. All right. We had a credit change here because of the credit for the dependent care credit. Okay. So basically we have everything that's here. Line 18, down here at the bottom section, this is where you have to be very careful, because if you do an amended return, you have to make sure that you understand what happened with the previous return. Okay. So this section and this section, you have to make sure you understand the previous return. Well, we knew in the previous return, if you look right here in this gray box with the red writing, there's that original refund that they had. Okay, so that being said that that's there, you can see that this is their new refund, and then you can see that the amount that they are going to be refunded. So they have an additional $518 coming to them. Okay. On part 2, you have to give a little explanation, and you might say addition of student loan interest and okay, and then so you would put that in there and then do the date and everything for the return. Okay, so basically that's how an amended return is handled. All right, now if it's the case on this one that they would like to do some payment of estimated, okay, and again, if we look at the state, everything else on the state's going to be handled the same way. We take a look, the state on the last page, there's their refund prior. All right, they're going to get an additional refund of $131. Now, if they had not gotten their original refund, maybe it was held up because of something that was on there, then you wouldn't put anything in there. So then you can see that the refund would go up here. But because they've got that original refund, then that's the additional money that they're due from the state government. Okay. And then you would also complete on the final part as to why. And again, you put in there. Okay, so we've added that to our, as far as our return for everything that's done on the amended return. Okay, now we have one other thing that we're going to do with this that I want to kind of show you, and that's estimated. But before I do that, you know, you've made changes to the 1040. You're going, well, how do I know what I did? Okay, if you go up to File and you go down to Return Versions, you can hit, there's the current one, and you can see that before I made the changes, there was one that was earlier. Okay, so the original return, we can click on that. Turns everything around the return red. Okay, and we can't do anything in this return, but now it shows us the original return before we did the amendments. Okay, and then to go back to our current version, we go up to File, Return Versions, and hit Current Return, and it brings us back to the return that we're working on right now. So that way you still have, if you don't have a paper copy, you still have access to a copy of the return that is on the original one. Okay, now the one other thing that we're going to talk about is estimated payments. Okay, so add a form. All right, if you go down here, you can see 1040 ES, Estimated Tax Worksheet. All right, so we click on, we open that. Okay, and they were concerned about something they got, and basically you can see here that you can kind of estimate for the upcoming year. All right, because this is a 2016 tax year, a 2017 estimated tax worksheet. Say that they were going to have, you know, something that was going to change their return considerably. Maybe an inheritance or the sale of mom and dad's house for capital gains or whatever it may be. Well, you could go through and basically create what you think the return is going to look like next year based on all the things that they might know. And that's going to get, or you can come right to the bottom. And if you go right down to the bottom here, you can see that it says estimated payments. Okay, talks about the $1,000. You're not required, but estimated desired if you have a specific amount that you would like to put in. So in this case, they know they're going to have $5,000 capital gains, and they want to make sure that they have $5,000 paid ahead of time for 2017 because they've sold mom and dad's house, you know, right before they came in to see you to prepare their 2016 return. I put that in. You can see on the tree on the left, it made little estimated payments. It will create, when you print out, little vouchers that has all their information on it and the due date for each of those. Okay, so that's where you would do that. All right, that's to create the estimated payments. Now, we're going to say that they've made those estimated payments for the current tax year. So we're going to go to 1040 page 2, and we go down here. We have estimated payments. We've seen this sheet before when we did things with the payment of state taxes. But on this one, when we take a look at it, if they made estimated payments in the prior year, we're going to put the date of payment, the amount of the payment, okay, and that'll go towards their estimated. Now, some people, what they do, if you see here where it says from last year, if they have a refund, they might roll it over from the previous year into next year. Sometimes you'll see people do this with estimated payments. If they have a refund, they kind of bank it, let it sit there. I mean, granted, yes, it is with the IRS interest-free, but it's another way for them to put that estimated payment on there. Okay? So that's the way you do estimated and amended payments. Any questions on anything there? Okay. Okay. Okay, so we're going to talk a little bit about some of the New York considerations real quick. We'll do this just within a return, okay? kind of go through some of the lines on the New York here. All right. We've talked about a lot of the different things. You know, everything comes over from the federal and the state that are the same. Couple of the credits that we've talked about were the real property tax credit. That's that you know, credit that's there. Non-custodial. That non-custodial parent one. If you have a parent that's paying child support and they are current, they can get a non-custodial parent earned income credit. They know about this. Anybody that gets a statement from the court showing that they are current on their child support, there's always a little orange sheet in there that tells them, since you are current, make sure you take advantage of the earned income credit, non-custodial parent earned income credit, and they'll know that to put that on the return. Okay. Couple other ones that are in here. We're going to talk just a little bit about right off the at a form. Okay. We have the, let's see, what other ones do we want to talk about? We've done that one. We've done that one. One other one that comes up quite often because of Western New York is the IT 245. This is a credit that is $200 for a volunteer fireman and ambulance credit worker. Okay. Pretty straightforward. You just have to make sure that you know the individual. In this case, we're going to say yes and no. So we know David. We'd have to know the volunteer fire company's name and their address. And again, $200 refundable credit for them on the return. Okay. The other one that is in there that shows up quite often, let's see here. The nursing home credit. We talked a little bit about this one. This is a 6%, what they basically is a bed tax that when somebody's in a nursing home, if they're in a certain facility that pays the New York State assessment or bed tax, that is a refundable credit on the person's return that is in the nursing home. I have seen this one be $6,000, $7,000, $8,000. People can file a New York State return with no taxable income and get this money back. So it's one that if you have somebody that's older or somebody that's filing a return for an elderly parent, you want to make sure that you ask them about this claim for the nursing home assessment credit. Okay. All right. The one other one that comes up that I want to just talk about briefly before we go into the kind of our open forum here to kind of answer any questions that you have is that there is one. Give me 1 second here. Trying to think if there's any other credits that we want to talk about here. We'll talk about the injured spouse and innocent spouse. We've talked about it a little bit on some different things. What the injured spouse is that if you have two taxpayers, in this case we have David and Sheila Strong, and the two of them are filing a joint return, one of them comes into the marriage, or maybe because of other circumstances, student loans, previous marriage, child support, some other IRS debt, whatever it may be, that their refund is basically confiscated or taken to pay off past debt. What the injured spouse allows you to do is it creates a partition on the refund between the injured, between the non-obligated, which it's called on New York, or the injured spouse. Okay. So if in this case it is David that is the injured spouse, okay, it's asking. A joint overpayment, yes. Are you legally obligated to pay this? No, because this, again, we're answering this in the case of the injured spouse. We don't reside in any of the states there. And you're going to answer no. And oops. Okay, so we have that. Then when we get to this point, we can see who is the injured spouse. In this case, it is David. He is the one that does not have an obligation on the return. Okay. When you go to the second page, oops, too far down here. Okay. And you go to the second page, you can see here where we have the opportunity to kind of allot things. In this case, there's some credits that are here that we're going to move, and we want to make sure that they're allocated to the injured spouse in the amount of that credit, and that way we make sure that that is not lost or confiscated so that it can still go to, in this case, the child tax credit and dependent care for the kids to the household. As you can see, column C is where the other parent is, and maybe Sheila has student loans that they're taking her refund. Well, her portion of the refund may be confiscated and taken to pay that, but you've created a partition between the two of them, okay? On the state side, there is a very similar form that you would do. Okay, called a non-obligated spouse. And again, David is our non-obligated spouse. Okay, and you would answer that. And very similar to the federal, you can see where the calculation is keeping anything that would be subject to be taken. It keeps it under the non-obligated spouse so that the other spouse does not, you know, whatever their situation or financial situation is, it doesn't allow that refund to be confiscated. Okay. All right. Okay. So what I want to do at this time is just kind of open things up here. If there's any questions about anything, you can use the chat. You can use, if you want to pop your microphone on, we can discuss. If you have certain questions or problems or chapters or topics that you would like me to go to, we can do that. I will do everything short of giving you the answer to the final return. I think I told last week, and for those that do watch the videos, that you will make sure that you want to know your income, students, and then the other thing is schedules A, B, C, D, E. Okay, so a lot of the return has to do with those schedules. All right, for those that haven't scheduled their midterm to be taken in the office, I will be mailing it out later today. I just kind of want to give a chance for everybody to schedule that's coming into the office. Everybody else will get it via email with a time frame to finish that final. Okay. If you have not completed also your interest in working for us, if that's something you're deciding to do, you know, that form there, I'll probably send that out with that also. Okay. All right. Hold on. We got several things flooding in here. Let's see how. As far as calculating the Social Security and Medicare withholdings, that is something that's just kind of a standard rate. There's not a lot of times that there's anything we can do as far as the return. You know, that comes over on the W-2 unless you're doing the self-employment. But, you know, those are kind of set percentages. When we're talking about withholding, typically the only withholding we're talking about that we have a chance to manipulate or adjust is the state and federal tax withholding. So there's not a lot we can do with anything on the Medicare and stuff withholding. Okay. Question, maybe tell us about. Okay, so we had a question about the handling of the tuition. Okay, Um, we're hoping, and everything that has been an indication from the IRS is the fact that the 1098-Ts are supposedly going to be much more accurate. Nothing worse than getting a 1098-T where there's only something in box 2 that says the amount billed. We're working with a client right now, and the university that his wife had attended on that 1098-T, that number that was stated there and what actually showed up as what they paid was 2 totally different numbers, okay? So they billed a certain amount, but when you went back and looked at the statement of student account for that individual, and that's what I mean by that is it's kind of something that shows here's their tuition billed, and here comes our scholarship, student loans, visa payments, check payments, whatever it may be. Those did not add up. So the IRS saw this and said, hold on, you took too much of the credit because you didn't really pay that much. So we had to go back and get records. And sure enough, the statement of student account didn't match up with the 1098-T. So we had to have the individual do some things with finding receipts for books, anything else that would be qualified educational expenses. So we're hoping that the 1098-Ts come in more accurate. If there is excess where the scholarship is greater than the tuition paid, that unless it was used to buy books and anything else, but if it's excess, then it goes on line 7 as income for the student, okay? It doesn't go on income for the parents. It goes on the tax return of the student as income, okay? So that's the way that you handle that, all right? Let's see here. We had a question about, what is it? Well, as far as the earned income credit, it's not really the amount of hours that you work or how many days or if you're part-time, full-time, whatever it is. It's really just based purely on the income, okay? Remember I talked about that the earned income credit goes sharply up, kind of reaches a plateau between about 12 and 18,000 and then falls off after that, okay? So if somebody has, they only have $1,000 of earned income, they're not going to get much of an earned income credit. It's not like that credit's going to make up the difference to get them to the poverty level, okay? So, if they work one day, and if that one day makes them $10,000, then they're probably going to get a decent earned income credit. But that's probably only if they're filing head of household with dependents. A single individual, that earned income credit really doesn't kick in. The earned income credit really is there to subsidize, if you will, the income of a household where there's children, okay? That's where you see the biggest benefit for the earned income credit. That's why with fraud and things like that, when you read the section on ethics about earned income credit, much more of it has to do with due diligence to prove that that child is the qualifying child of the taxpayer and or lives with them, all those different things that we have to do on that due diligence. That's why you see that on that earned income credit due diligence, okay? Question in the text. Okay, so you're getting a red box within the tax-wise, okay? Typically what happens in that, when you've done that, you've actually probably had to enter something on a worksheet as opposed to putting it directly on the form, especially with the 1040. Where I see that most often is, let me show you here. Maybe you'll tell me if this is the situation you run into, okay? On the form, a lot of times I'll see somebody just put in here, or maybe they'll put $1,000, okay? But then they'll realize that this doesn't go there. They have to put it on a form, okay? See if I can make the red show up. Okay, so we have that on the form. Yeah, it didn't do it. Typically, I see a lot of times with the educator expense, The other time that it shows up too is if you, and again, I stressed with the Schedule E, do not use the Rental A worksheet, okay? So if we look at this, let me see if I can get one to create. Okay, so I'm in here for this, and I go in to put my rental income in. I said, hey, I'm going to do this because they're only renting it for part of the year, okay? Once I've created that, and if I go back to my Schedule E, okay, I can't put anything in here now, okay? Everything has to go on my other part, all right? So what I mean by that is if you look at column B, all the zeros are still green. I can put it directly on my Schedule E. Under the A, now I'm stuck using my Rental A worksheet. The problem with these Rental A worksheets is they don't carry forward and they're very difficult to use. So do not use them. If you end up using one, my suggestion is if it's a new client, just start over. All right, I would get rid of the Rental A. Okay, and I would get rid of the Schedule E and start all over again. Okay, you know, typically, like I said, that's there that if you have to put those in and you get that red box, it's where you have to kind of almost go backwards. Okay, all right. Let's see here. We had schedule fields do not update 1040. As far as which schedules or fields when completed do not update the 1040, they all should go to the 1040 if they're required to, okay? If they don't flow there, then again, we've probably done a sequence of things within the tax-wise that it's not allowed us to have it calculated. If you get a situation like that and you know it's supposed to carry the 1040, go into the box where you know it's supposed to be and hit Shift F8. It was one of those things I think I sent out on the shortcut, the keyboard shortcut sheet. But if you go into that box, hit Shift F8, it'll override so that the calculation comes over for you. Okay. Another question is, will we be doing depreciation and amortization on the exam? Chances are, Matt, if we're doing a Schedule C and a Schedule E, there's going to be depreciation on there, okay? It's my guess since we spent so much time on C's and E's and depreciation, so I would hope that it's not a surprise if you do see it, but just make sure you follow the instructions. The one thing I will give you guys that are here listening as far as a heads up, on the tax documents for the final, make sure that you read the documents completely, okay? Just as a hint, sometimes mortgage or 1098s that show mortgage interest and property taxes aren't what they appear to be, okay? So make sure that you read it completely. There's a difference between the mailing address and the property address is what I will say, okay? So make sure you read it completely. All right. Any other questions? And again, if anybody wants to turn the mic off so we can hear the questions, that's fine too. Okay, so any other questions that we have? Very time to type here. Okay. All right, everybody's done great. You know, I know it's tough with online sometimes with the learning and not being in the classroom. I know it's tough too with the you know, having to do the returns in the TaxWise software. Everybody's been great on that. Hope sending out the problems and stuff, you can kind of take a look as to where those are. Try to spend as much time as I can in the return so you can go back and review the procedure. You know, but everybody's been doing great on that. Okay. Let's see here. We had, can you review the child tax credit, refundable versus non-refundable, and when to use it? As far as the, again, do the bare essence of whatever credit it may be. If it's a child tax credit or the American Opportunity Credit, just remember that it has components that are refundable and non-refundable, okay? As far as when to use it, non-refundable credits are the ones that are our Pac-Man credits. They eat up the tax refund, and once they've consumed it, if there's anything left over, it becomes refundable, okay? So that's when we would use the refundable portion of the child tax credit, all right? There's kind of a hierarchy that happens as far as which credits eat up the tax bill first. The ones that you're going to use first are those ones that do not have a refundable portion. So what I would mean by that is credits that are only non-refundable or Pac-Man credits, they're going to be used up first. And if they eat up the tax bill before you get to the credits that may have a refundable portion, or Energizer Bunny credits, then they're going to be used, and then the remaining will go down and be part of the refund under the refundable portion. Okay? Does that answer the question on that? Okay. Will EG Tax send out a video explaining? Okay, so the question was, will EG send out a video explaining the tax changes or the new tax law? We are going to have a training session that we do. We'll send out things. We create little sheets that talk about all the new tax changes. We'll make sure that you get those. As far as the tax law changes from what will be the tax law for 18 versus 17, still be determined. I was reading this morning on some of the news outlets as far as how the reconciliation is going between the two houses of Congress and what they're coming out with. Sounds like there may be a vote next week. I know Esther has been great on the radio show that we have recordings on, where you go to see the recordings of the your lectures. We've been trying to put stuff on the website. Obviously, it is a very fluid situation that changes. Some of the things have even changed from what I knew yesterday to what I read that happened last night with different things. It looks like they went back to 7 tax brackets from the 3 that they were trying to do. But as far as 17, yes, we'll send everything out that you would need to know about any changes. Aren't many huge changes right now with 17. So, all right. Okay, salt tax. That's a little bit different because we got 2 different places that we're talking about, okay? State and local tax, what the salt is that is the one where they're talking about state tax may be withheld from your paycheck, not being able to use. The other 10,000 is property tax, where they're creating limitations. So we kind of have an apple and an orange there, okay? So that's where a lot of the negotiations are happening, especially for states like New York, like California, Massachusetts, Maryland, high tax states, New Jersey, where they have a lot of tax. The one that they're talking about that's going to hurt the most is for those individuals that are losing their state and local tax, like their tax withholding, okay? Property tax is the one that's going to be capped. Residents, only one residence up to 10,000, different things like that. What they're trying to do is almost force people into having to take the standard deduction, okay? All right, okay. All right. And if you truly want a video explaining it, I guess you should probably call your congressman or your senator and see how much they actually know about the law. I don't think a lot of them understand the impact. Esther's been great. We've been trying to come up, we're going to put on the website a little spreadsheet that will give the calculations as to what the different impacts will be. Every time we think we get the spreadsheet figured out, we have somebody in Congress say, hey, what about my state? Marco Rubio, the whole thing with the child tax credit, now it's up to $2,000 as opposed to $1,000 to try to offset the loss of the exemptions. So, things change so fast. We're trying to keep everybody updated until the vote and the law is in place and we can truly pick it apart. One I had is somebody with alimony. Under the new law, the alimony is no longer taxable income, nor is it a deduction or adjustment to income like we've talked about. It's been interesting. I guess the one blessing in this is that the law will only be in effect for divorces that happened after 2017. So if you have an existing divorce decree that shows alimony, then you can still handle things the same way that you have in the past. If you get divorced after, it's a whole new ballgame, okay? Because that income is now not deductible that you would be paying an alimony. Example is we sat down with a client and we were kind of picking it apart, and I found that because of the way his tax return worked and the way the kids were handled, it could have been a $7,000 swing for him, okay? He would have had an additional $7,000 in tax if they would have had this go back retroactive to anybody that had divorced with alimony. That's a lot of money. That is a huge penalty to that individual, okay? So that being said, the way as the articles that I've read on divorce, the way that the lawyers are talking about it, it's going to change the way that divorces are handled and how that money that is paid between the two parties, how it is determined, okay? All right. Okay. Any other questions? Like I said, the final is not bad. There's a family called the Demics. They are a family. There are some tuition. There are some, but there's some decent things with Schedule A's, B's, C's, D's, E's, okay? I am not going to torture you with F's, even though I grew up in farm country. I'm not going to torture you with doing a farm return, nor am I going to torture you with any H's, no household employees, okay? I'm looking forward to meeting those of you that are coming into the office. If you have not contacted, please let me know that you're coming in to do the exam. Like I said, I'm just trying to, before I send the exam out to everybody else for the final exam, to have it done. I'm going to have it turned around pretty quick. We want to get everything done, especially for those that are planning to work for us with the interviews, to make sure you've completed the class. But that's why we're having a kind of a quick turnaround after this last class with the final. But I have enjoyed it. Like I said, you have all my contact information. I know some of you have taken advantage of individual Zoom sessions to try to do things. When you're in the offices or you're doing tax returns or whatever it may be, don't hesitate to reach out. I am a resource, just as anybody else will be that you're doing. For those of you that are out of state, I'll be mailing you the certificate completion so that they know that you have completed the course. It does get you 8 continuing education hours for certification. It also will show that if you choose to work for somebody in the area that you're in out of state, that you have completed this course and that you have knowledge of the tax law, and that you can work for somebody doing taxes, or maybe pick up a part-time job somewhere else. So we encourage everybody that has worked and done the class with us that you take advantage of working for EG. It's a great thing to do during obviously these long winter times as we're seeing right now in Buffalo. But I do appreciate everybody's participation in the class and hope to see everybody working for us. So, okay. All right. If there is nothing else, I'm going to wrap it up. Like I said, for those of you that are not coming in, I will be emailing you the final with the instructions on how I want it turned in and the timetable. For those of you that have scheduled times to come in, obviously if the weather or changing your schedule, let me know. This time of year, I know our corporate office is only open from 9 to 5, Monday through Friday, but I am here a lot more often than that, before and after hours. So if I need to stay late at a night, after 5 o'clock to have you come in, that's not a problem. I have plenty of work to keep me busy. Those are things that we will do to make sure you complete the class and have a full understanding of the material. Okay. All right. Well, again, thank you everybody for taking part in the class, and hope that you've learned a lot about taxes. Obviously, this is a basic class. We try to cover the material that we could. There are advanced classes that you can take next year. There's classes in prepping you for the EA and other things like that, which is enrolled agent. But make sure that you keep learning, and don't hesitate to contact me, ask questions, or anything else like that. Okay. All right.